We need them to find us on when they arrive. Thank you so much. We've added a bunch of additional seats up here, and you can, if you're scared, you can have access to the restrooms through the side there. So please feel free to come up. There's a bunch more seats over there. Now I'm just waiting for my cue for the webcast, so please bear with me. I got good to go. I am so excited. This is very cool, and I can't thank all of you enough for coming. Let me also welcome those of you who have logged on to the webcast and are joining us now or in the future electronically. This is the beginning of a new chapter for a body of work at the Urban Institute that builds on its historical strengths and draws in many people who've been here, along with a wonderful new team. And I'm really excited to spend just a minute telling you about why we did this. And then we'll hear very briefly from those who helped to make the launch of the center possible. And then we're going to actually go right to the meat and have a panel discussion where Laurie and the team will talk about some of the work that they've done and some of its implications for housing finance going forward. So let me start with why we thought there was a need for a housing finance policy center at the Urban Institute. There were basically two core observations. The first is that most of the debates about the mortgage market exist in two polar, separate universes, one of which is about places and people and household finances and consumer balance sheets and neighborhood impacts, and another is about capital markets and stability and liquidity. And as we went through this last crisis, we found out that many of the most powerful tools that have implications for people and places are really policies that are designed at the financial market structural level. And they're often designed without regard to those other concerns, or those concerns, if they're there, are secondary. And what we also find is there's very little common knowledge between the two universes. And so when they do try to talk to one another, they speak past one another. So the first observation was it possible to create a hub around which information could be shared that could create a common language and that could try to bridge those two conversations so that the policy that we make works from a capital markets and a financial stability perspective and works for people and households and communities. The second observation was that the Urban Institute, a place I arrived, luckily for me, 20 months ago, had a long, rich tradition of bringing data and analytics to policy conversations. And yet, so much of the conversation about housing finance reform was short on data and analytics that came from independent perspectives. And so our question was, could we add value? We had wonderful resources here, and you'll see them later today, that looked at the tax policy effects on housing and consumer finance and wealth building and neighborhood and community and demographics and change and how that was affecting the housing market. But there was no connection of that to finance. Could we bring those together? And I did the smartest thing I ever do whenever I try to solve a problem, which is I call Ellen Seidman. And I said, Ellen, would you figure out if there's white space here that we could add value? And Ellen, many people in this room and others talked to her about where that white space could be, and that really helped to envision the plan. The second great thing that came from that conversation was that one of the people Ellen called was Laurie Goodman. And as you all know, Laurie Goodman has been the most important voice telling investors how public policy changes in the crisis were affecting their portfolios, but she had gotten increasingly more and more interested in those policy changes and understanding them. And when Ellen went to see her, she said, I'd like to be part of that. And that was the beginning of a really beautiful relationship. And so the vision now is to create one place where we bring that data and analytics together. And that capacity only works if it's at the ready. That means that, and much like other parts of urban, like the Tax Policy Center have proven, you need to build you need to house the data. You need to have it at your ready. You need to have people who know how to use it and understand it well. You need to have modeling eventually, we hope, over time also. All those are capacities, and it takes funders who understand that the insight is not simply just to fund a particular piece of paper, a particular body of research, but rather to fund a capacity to add value to the debate. And that's why we are so grateful to the folks that we have today. So I'm going to introduce all three of them now, say one more thing, and then I will ask them just to come up, and then we'll go straight from there to Laurie. We've been very lucky to start the center today with leadership level support from our friends at the MacArthur Foundation and the Citi Foundation, and also the Open Society Foundation and the Ford Foundation are key supporters of this launch. And we're going to hear today, and I have to get the order right here, from Jeff Jaffe at Citi Foundation, Solomon Greene from OSF, and Allison Clark from MacArthur. Before I do that, let me just say one more word about the extraordinary folks here at Urban. Laurie will introduce them all. But there's a really great team already here. Rolf, Eric, and Signa Mary are just the tip of an iceberg of research analysts and others. Laurie has assembled a great group of people who we've brought in, but what she's found is that the analysts here are such important contributors. Being able to find, to get Jim Parrott and Ellen to stay and be part of this center. Ed Golding, who's now at HUD, was part of the launching as well. Somebody analogized me to George Steinbrenner, and initially that was not an analogy that I found particularly flattering. But I thought about it for a minute. And I grew up in New York, and I am a Mets fan, even worse, right? But I thought about it for a minute, and I said, well, if what that means is someone who's smart enough to hire and assemble and find really great talent, I'll take that compliment any day. So if I'm George Steinbrenner, I guess that means that Laurie Goodman is what A-Rod would be without steroids. So... So with that, I'll let Laurie introduce the rest of the all-star lineup of the Urban Institute's Yankees. But before that, first, let me introduce Jeff Jaffe. Thanks, Jeff.
Thanks very much, Sarah. It's not often that you have two Met fans get to speak back to back, so we have a lot to talk about. But first, I'm here on behalf of my good friends at the Citi Foundation who provided leadership support for the launching of the Institute. And I can't tell you how happy I am. I can tell you about 15 years ago, around the time we were having debates around subprime lending and things like that, I went to my friends at the foundation and I said, gee, we really ought to fund some research. We ought to be able to figure out, because there's a lot of decisions being made that are being made based on not really good research. And my friends at the foundation said, Jeff, you're a mortgage guy. You seem really smart, but this is not your area of expertise. What you really need to have is exactly what Sarah talked about. You need to have research, you need to have analytics, and you need to be able to convene the conversation. And if you look around the people in this room, you certainly have a great place to start. So we're delighted to be a part of it, and we're delighted to be here on day one, and we're really looking forward for us and others to be part of this conversation. It's a very important field, and thank you very much for the opportunity to be here.
Hi, good afternoon. I'm Solomon Greene from the Open Society Foundations, and I want to thank Sarah and the Urban Institute for hosting us this afternoon for what will be a very important and timely discussion, but more importantly for the beginning of an ongoing discussion around the complexities and the importance of sound housing finance policies in the U.S. Delighted at the Open Society Foundations to be able to support this effort. for us, I would never refer to a grant as a no-brainer because we put a lot of work and effort, and we yes, Sarah could attest. We put a lot of work and thought and effort into. We take our investments very seriously, and the scarce resources we have in allocating them very seriously. And we spend a lot of time with Sarah and the team here discussing and learning about the center. But it was a no-brainer in the sense that for us it just hit so many of our grant-making priorities and goals. At a very focused and targeted level, we've prioritized, in the wake of the foreclosure crisis, a need to rebuild the housing finance system in a way that promotes access and affordability to underserved borrowers. We had been investing in foreclosure response efforts for over 5 years through our neighborhood stabilization initiative across the range of responses from foreclosure prevention through neighborhood stabilization. And I think at the end of 5 years of making those investments, what we realized is perhaps the most vexing and enduring threat and perverse outcome of the crisis, in addition to all of the harm that was done over the course of the crisis to hardest hit communities, would be that we may learn the wrong lessons from the crisis. And as we go about rebuilding the housing finance system, we may be basing some of those really critical policies on misinformation and lack of deep knowledge of what caused the crisis. And so we have prioritized a range of efforts from research through community engagement and communications to help rebuild the housing finance system in a way that promotes access and affordability and learns the right lessons. And I think the center is going to play a critical role, not just in projecting forward, which I think is the focus of its research, but also thinking very critically and thoughtfully about what we can learn over the experience of the past 7 years. At the very macro level, I should say that as the Open Society Foundations, our core mission is to ensure strong civil society institutions that are able to promote open government and informed and participatory decision making. And so even setting aside the importance of this effort for housing finance reform debates, we see the Urban Institute generally as playing a critical role in our core mission. I think the housing finance reform issue is particularly prone to opacity. And we see for two real reasons. One is I think that the issue itself is complex and doesn't lend itself readily to community engagement, and is generally inaccessible to the type of civil society institutions that we support. And then also the data that's necessary to answer the critical questions is costly, complex, and also inaccessible to those groups. So we are very excited that the Urban Institute has taken up the challenge of addressing both of those issues in terms of serving as a data repository, as a research hub, and also helping to insert housing finance reform into a broader public debate. And it's just, it fills such a critical need. And I didn't use the George Steinbrenner analogy in our grant recommendation, but I did refer to the team that Sarah has assembled here as the dream team, and it really is, of experts who are up to the challenge that the center has taken on. And I am cognizant, humbled to be able to share the podium with them, and cognizant that my remarks cut into what's going to be a really rich discussion momentarily. So I'll keep it short. But the one thing I just wanted to add is that as effective as the dream team is here at the Urban Institute, and as much confidence and faith as we at the foundation put in them, they can't do it alone. So I'm excited to see that the Urban Institute is amplifying their expertise through the creation of an academic council. I'm excited that industry partners are engaged in this process to be able to inform the research and help champion smart policies that are come out of the research. And I think it's also critically important that community groups, consumer advocacy groups, and a broader group of spokespeople are able to bring this debate out into the public, help translate it, and help communities understand the importance of this debate for their future. And so I'm really excited to see some of those people who are able to serve that translator role and that community engagement role in the room today. And I'm confident that this signals the start of a very strong and enduring partnership with everyone in the room. And we're off to a great start. So thank you.
Hi, I'll be brief. I'm Allison Clark from the MacArthur Foundation, and I'm delighted to be representing the housing team. My colleagues Julia Stash and Yana Kachoris were not able to be with here today, so they sent me. I don't know what that would be. I guess I'm called up from the bullpen. But as we are all aware, the debate about the next generation of housing policies in this country is already underway. However, until now, something critical was missing in this debate: an agile, rigorous, and credible source for the most sophisticated research and analysis that could help inform policymakers and the public about issues related to this most important part of our financial system. The new center is the missing piece, we believe, of that puzzle. We're pleased to be here and to help make it a reality. We expect that the new center will build upon the Institute's reputation for performing rigorous research, and that it will fill a critical need for credible, nonpartisan research and analysis to assist policymakers in the reform of the nation's housing finance system. Such research is more critical than ever, as whatever reforms are to be implemented now will need to address the demands of investors, the business community, and the individual consumers that depend upon a sound housing finance system. We believe that the center complements and bolsters the ongoing efforts supported by the Foundation to ensure that the reform of the housing finance system is evidence-based and designed to allow a stable, sustainable recovery of the housing markets in the United States. We also hope that the center can help break through some of the partisan gridlock in Washington by providing data analysis on the implications of housing policy choices so that the new policies will be thoughtfully crafted to meet the housing needs of Americans at all points on the income spectrum and in communities and regardless of housing tenure. Indeed, if a stock of decent, stable, and affordable housing is, as I would assert, part of the nation's critical infrastructure, then a safe, well-functioning, and accessible housing finance system is not only necessary, but is an essential part of the nation's financial program. Congratulations to all of you again at the Urban Institute for making the Housing Finance Policy Center a reality, and we look forward to partnering with you on the next step of this journey. Thank you.
Well, thank you all for being here today, and thanks for those of you who are listening in on the webcast. I'd like to give a special note of thanks to Sarah for originally having the vision for the center, the drive and confidence to seek the initial funding to make it happen, and her continuous support in thousands of ways, big and small. A special thanks to the funders, the Citi Foundation, the MacArthur Foundation, the Ford Foundation, and the Open Society Foundations for making this center a reality. We couldn't have done it without you. My name is Laurie Goodman, and I'm very excited to be joining Urban as a center director for the new Housing Finance Policy Center. A few words about my journey that Sarah partially told. I spent just short of 30 years in various research positions on Wall Street. Actually, November would have been my 30th anniversary, where I was a well-regarded analyst specializing in the mortgage-backed securities market. In the aftermath of the crisis, I began to look very closely at public policy toward housing and housing finance, initially because of the impact on the valuations of the securities I was analyzing, and later because I just became interested in it. On Wall Street, we obviously had a considerable amount of data, allowing us to use it to inform the housing debate, but we're not primarily geared in that direction. It was almost a hobby, with securities valuation as the day job. Over the post-crisis period, I became less interested in securities valuation, more interested in policy issues, and increasingly convinced that there was a huge need for an independent, data-driven voice on housing finance policy issues. So when Ellen called me and I heard Urban was looking for someone to fill the role of center director, it just seemed natural to stick up my hand. I'd like to spend the next few minutes first introducing my team, describing the infrastructure we've built, the research we've done to date, and what we hope to do going forward. And, you know, as I called members of my team, if each of you could please stand up. First, senior fellows, Ellen Seidman. Ellen is my partner in the center in every way. She brings an impressive resume to this job, including concurrently being a visiting scholar at the San Francisco Fed, the previous director of the Office of Thrift Supervision, and special assistant to the president at the National Economic Council. In addition, she was the consultant who worked with Sarah to sketch out the initial vision for this center. She's worked with me on every single item from the logistics of our data talks to negotiating data contracts to hiring. Moreover, Ellen is one of those rare people who makes everyone around her better, and she's given thoughtful comments on every single research piece we've done. Jim Parrott was a senior advisor with the National Economic Council, focusing on housing issues, and before that was at HUD working with Secretary Donovan, also on housing issues. Jim is a wonderful colleague, extremely knowledgeable about housing and housing finance, and instrumental in steering us so we can maximize our contribution. He also brings that 360-degree perspective, which on occasion I find irritating, able to see all sides of an issue, and the Washington insider knowledge of the politics of any situation. June Zhu, a senior methodologist, has made a huge contribution. She came to us after several years as a senior economist at Freddie Mac and has been instrumental in building our data infrastructure, which will be the foundation of our work. She's also been extremely productive as my co-author on a number of papers that are being handed out today in this booklet. We've also made 2 more quantitative hires earlier this month. Wei Lee comes to us after close to a decade at the Center for Responsible Lending, where he was a principal researcher and responsible for much of the excellent work they have done through the years. You'll be seeing much more of him in the months ahead. Bing Bai, who's I see in the back, has recently joined us as a research associate. He was at Freddie Mac over the past year doing economic modeling, and he's going to be working with us to analyze the latest housing finance developments. Pam Lee is a research associate at Urban. She's been here about a year and is the person responsible for the eminent domain piece that you'll find in the packet. In this paper, she looked at several cities, including Richmond, California, that have considered this controversial strategy, and looking at what each of these cities have in common. She concluded the plan, as proposed, did not address the problems they face. Great researcher and very, very talented at putting materials together. Taz George and Maya Wallakem are the wonderful research assistants working with us on every project. Taz has been here just over a year and Maya about 3 months. And to the extent the chart book has parents, these folks are it. Allison Racone is a special assistant for the housing finance policy area. Her touch is on everything we've done. She expertly juggles a huge number of obligations and keeps the rest of us organized, and I can tell you that keeping me organized is no easy thing. And I'd like to give a special thanks to a few additional people at Urban. Making a transition from Wall Street to a nonprofit hasn't always been easy, fun, and clearly involves some amount of culture shock. 2 people that have made this process less traumatic than it otherwise would have been. Marge Turner, the head of research, has provided valuable counsel on how to run a center and how to navigate Urban. Rolf Pendle, as head of the Metropolitan Policy Center in which we're housed, has been a wonderful colleague, both providing thoughtful comments on research topics and advising me on how to get things done in this environment. Many Metro colleagues have also helped us get started. Tim Ware, Janine Zanavello, and Diane Hendricks in particular. There are many people at Urban that have contributed to our efforts. We'd like to thank the entire comms team led by Bridget Lowell. A few people on the team have devoted large parts of their life in the past few months to us. Amy Ellsbury, Daphne Bond Godfrey, and Elizabeth Vargas, who had made both this event and the many other events that preceded it go smoothly. Zach McDade and Nicole Levins have made blogging easy. Fiona Bradshaw is our expert editor on the briefs. Jeff Taw and Dave Connell put together our website, which is also being released today. We'd like to thank the other internal groups that have also helped make this center a reality. HR, who's expedited our hiring, POS for their logistical help, and IT for their support of our very large data needs. And it's wonderful to have other groups at Urban focusing on housing-related issues from a different perspective. Rolf has done some fabulous work on demographics. Signa Mary McKernan has done really interesting work on opportunities and ownership. And the Tax Policy Center, with such great researchers as Eric Toder looking at the mortgage interest deduction and other housing subsidies, is a great plus. Obviously, the key to doing data-driven research is, of course, the data. CoreLogic, an incredible provider of data, has become a strategic partner, providing us with servicing data, data on non-agency securities, and home price data. A special thanks to Faye Schwartz and Alana McCargo for making this happen. We've acquired agency data through EMBS. We've also mounted the new credit databases that Freddie and Fannie have released as part of their risk-sharing transactions. In addition to this, Urban has long used HMDA data and in fact has been best known for putting HMDA data in a more user-friendly form for a broader audience. Going forward, we intend to tie the HMDA data together with the CoreLogic data to give us a more complete view of borrower characteristics at origination, and Wei Li is currently working on this project. The goals of our center are threefold. First, we intend to provide data-driven analysis of policy issues. Second, become the go-to source for policymakers and others on some of the data. And third, connect research programs around the country in housing finance with each other and with DC. So let me discuss each of these goals in turn and our progress to date. First, providing data-driven analysis of policy issues. We have two main channels for distributing our topical research: blogs and issue briefs. We've done 6 blogs so far. The first was Jim Parrott's examination of President Obama's housing speech in Phoenix. The last 2, authored by Ellen, June, and I, have been on the credit risk retention proposal, otherwise known as QRM. In our blogs, we looked at the number of borrowers that would have qualified if the proposal was adopted as is, and the number that would qualify under the more stringent alternative, making the case that while the default rate on the alternative was low, very few borrowers qualify, and even fewer purchase borrowers. We're submitting a comment letter on this proposal, and a draft of the comment letter is in your packet. The first of our, we're also distributing our first set of issues briefs today. There are 3 issues briefs in your packet. Eminent domain, which I've already talked about, that Pam Lee wrote. We're also releasing one on the GSE reform debate, how much capital is enough, and a paper on reps and warrants. In the reps and warrants paper, we show, using GSE loan level credit data from their risk-sharing initiative, that the GSEs could institute shorter sunset periods and allow for loans with a less than perfect pay history at a very low cost, giving lenders more certainty and contributing to a wider credit box. Our future research topics include housing affordability and credit availability, the impact of changes in the HECM program, and what needs to be done to have a more vibrant private label securities market. We also have a number of events centered around policy issues. On November 20th, we're doing a symposium on housing finance with CoreLogic entitled Data, Demand, and Demographics. Those of you who would like an invite who perhaps haven't gotten one, just ask. We're also doing a series of sunset seminars with CoreLogic. The first on HAMP was in July, and we're slated to do several more over the next year. Our second goal is to grow our role as go-to analysts, able to answer questions from policymakers, academics, practitioners, advocates, and the media. The chart book is our signature piece in this effort. It's centered around government involvement in the mortgage market. We're also doing a series of data talks. We've done 5 so far and 1 more on December 9th. Our last talk last week featured Mike Fratantoni from the Mortgage Bankers Association and Frank Notaf from Freddie Mac discussing mortgage application data. We anticipate 6 to 8 data talks next year. And our final goal is coordination, connecting academic research programs around the country in housing finance with each other and with DC. We've formed an academic research council consisting of 14 distinguished academics. Our first meeting is next month, and we're going to discuss policy conclusions of some of the academic research that has been done, as well as give the academics a sense of what the pressing policy issues are. We appreciate your support. We look forward to hearing your thoughts on our various products, seeing you at our coming events, and engaging in lively dialogue with you in the months ahead. And with that, please excuse our panel as they take the stage to be mic'd so we can engage in a dynamic discussion on the future of housing finance in the broader context of household demographic changes, changing patterns of wealth accumulation and tax expenditures for housing. We're going to cover a range of near-term policy initiatives that are under consideration, and it'll be framed by new and recent research by the panelists. And let me actually take a moment to introduce them. Ellen Seidman is our moderator. Jim Parrott Senior Fellow. You met both of them earlier. Ralph Pendle is the Center Director for the Metropolitan Housing and Communities Policy Center at Urban. Signa Mary McKernan is a Senior Fellow and Co-Director of the Opportunity and Ownership Program at Urban. And Eric Toder is the Institute Fellow and Co-Director of the Urban's Brookings Tax Policy Center. And with that, let's kick off the panel discussion. Thank you very much.
So thank you, Laurie, and thank you, all of you in the room, and also those of you on the webcast. We're going to try to spend about, it looks like we got about 30 minutes for us to have a lively conversation, and then we will take questions from both you in the audience and also those on the webcast. On the audience people, if you would just hold until the end, we will get to you. Most of you. And then the webcast people, however, you can start submitting your questions right now by sending an email to events@urban.org. Okay? So in either case, please identify your name, identify yourself with your name and your affiliation. So, we've all been talking about the fact that we're in a period of significant turmoil in housing finance and the broader economy, but this isn't happening against a static demographic. From the question of who the new homebuyers and renters are going to be, what the division between homebuyers and renters is going to be, how the baby boomers are ever going to sell their houses. All these are really important questions, and Ralph, you've done an incredible amount of work on them. Would you like to talk to us about what we're facing?
Sure. Yeah, I'm glad to. I'd also say that Signa Mary has done a lot of work that's really highly complementary to the work I'll talk about now, and I think she'll talk about it a little bit too. You could be a duo. So that I see three really big macro trends that are going on right now. And that will be going on over the next 15 to 20 years. The first one, as everyone who reads the Washington Post has seen in the last week, is the Millennials. There's been a series about the Millennials in the Post that has been somewhat amusing and interesting, not always entirely data-packed, and we'll try to bring a little bit more of the data to the table as we go on. But this is a very large generation. In fact, it's the largest generation ever born in the United States, sort of on a 5-year by 5-year time period. They were born between 1980 and 1995 or so. And they're still arriving because folks from abroad tend to be in this age group still. There's about 82 million people in this generation if you sort of stretch it out to the year 2000. So it's a very big generation. They're still in the early years of their household formation process, but as many of you parents in the audience know, that they've been slowed down in their household formation, and they may still be living in your basements. But they're really getting ready to go just as much as you're ready to have them go. And there are really serious questions about how soon they'll be able to form households if they haven't already. And then ultimately about what their trajectory will be into homeownership. Now, last time we had this big a generation about to enter the housing market was about was about 1960 when the baby boomers first started moving out of their homes. And the mortgage finance system that we invented in the 1930s in the United States was almost tailor-made for the baby boom to enter the housing market and help them and their parents raise the homeownership rate in the United States from 40% to 62% over a course of a few decades. So the FHA and other kinds of innovations in the 1930s were really critical in establishing what we know of today as the mortgage system in the United States. I think one of the things that we'll see is that the decisions that get made about mortgage finance now will affect immediately the opportunity for the millennials, the children of the baby boom, to enter housing markets and to become homeowners or not, or to remain renters. And it'll also affect their decisions even about whether they want to form households at all. It's really critical right now. Will be responsible for forming 17 million households between 2010 and 2020. And a few others will be formed from other generations. So they're really where the action is right now. And the decisions that we make are going to be very important for them. So that's the first trend, what's happening with the millennials. A second really important trend is of course, the baby boomers and their aging. There are about 80 million baby boomers, almost as many baby boomers as there are millennials in the United States, those born between 1945 and 64. They are, of course, now entering their retirement years. As they enter their retirement years and the number of seniors swells in the population, we'll see special housing needs growing. Many seniors are living in houses they want to stay in, but those houses aren't necessarily all that well adapted for them. Their incomes will go down. Some of them will have enough assets to be able, in their housing value and otherwise, to adapt their houses, but not all of them will. So we may see growing needs for new kinds of financial products that allow them to stay in their homes comfortably and safely instead of having to move to long-term care options and nursing homes and the like. So this is another reason why now is a very important time to think about the mortgage finance system and what it allows us to do with housing wealth and housing assets. And then the third longer-term trend is that baby boomers and older generations are already moving away from some states. They're moving to group quarters and they're passing away. And they're doing that at rates that release increasing numbers of housing units into housing markets that already can't really soak up the supply, especially in the Great Lakes and especially in Michigan. And after decades of economic restructuring, these states and northern New England too have demographic profiles that just don't include all that many millennials. Since those millennials are the source of so much of the new household formation, those housing markets are really withering. They're having a very hard time recovering. This process will continue and it will spread. And so the question about how we deal with the demographic transition of the baby boomers who have transformed American housing markets in metropolitan areas since the day they were born and will continue to do so long after they all pass away. The answer about how we prepare ourselves in housing policy, but also in housing finance for that transition, I think is critical and is something that I'm looking very much forward to talking about with Laurie and other experts on housing finance from a demographic and housing policy standpoint. Obviously, wealth and wealth building and wealth transitions, wealth inheritance are all critically important to the baby boomers, but also to the echo boomers, their children. And that's a reason why I think it's so critical to hear about a little bit about the special challenges that millennials in particular, but others are having in wealth.
Yeah. And just
Go ahead,
to
Seidman.
chime in there on wealth is that a key challenge that home buyers and renters of the next 20 years are going to face is increasing wealth inequality among U.S. families. Younger generations are falling behind, and the racial wealth gap is not increasing or is not improving. Starting first with the young, in the United States, the expectation that is every generation is going to do better than the previous generation. As a country grows wealthier, like our country has, the expectation is that every generation is going to do better. But our research suggests that this is no longer necessarily the case. The average wealth of U.S. households doubled over the last quarter century. But if you look at the young among us, people in their 20s and 30s today, their wealth is on average lower than the wealth of 20 and 30-year-olds 25 years ago. So younger generations are stagnating at the same time as older generations are accumulating right now. That means limited wealth for Generation X and Gen Y. That means harder to come up with down payments for homes. So the main challenge is going to be to get these younger generations on a wealth accumulation path. And if you think about race in this here, as I shared in recent Senate testimony, the American dream remains out of reach for most African American and Hispanic families. Families of color are not catching up in terms of their wealth. The racial wealth gap is large. White families have 6 times the wealth of African American and Hispanic families. So that means for every $6 in wealth a white family has, an African American or Latino family has $1. And if you just stop and think about what that means and what that means for you, for your children, and for your grandchildren over the course of a life, it means that when an emergency hits, maybe when you want to help with your children with a down payment on a home, or your grandchildren with college tuition, those are major investments that help with mobility and self-sufficiency. They can be a stepping stone to the middle class. Also, you want to have a comfortable retirement, and lack of wealth is going to make that harder. So the future majority population of our country, that is families of color, are not on a firm wealth building path right now.
That's depressing enough. It would seem obvious now to turn to Laurie and talk about housing finance, but there's a lot of other stuff that the government does, and one of the biggest things it does is it collects taxes and then it spends them. And Eric has been spending a lot of time thinking about whether we're making the most use, in particular, of the parts of the tax code that relate to housing. And Eric, I know that the answer to that question is no. So why don't you describe a little bit more than no?
Okay, well, thank you, Ellen. I'm the odd person on this panel as the one who deals with taxes and not spending, but of course that's not really true, because much of the spending that we do in the federal government is hidden spending in the tax code in the form of special tax preferences, which have been called tax expenditures. The government keeps data on this and has been doing so for about 40 years. One of the biggest tax expenditures in the code is the mortgage interest deduction. It will cost, according to the Joint Tax Committee, about $380 billion in the next 5 years in lost revenue. Our models estimate that about 40 million households will benefit from this deduction in 2015, so it's quite a widespread provision. There are also other important tax preferences, including the deductibility of state and local property taxes and the exemption of the first $250,000 or $500,000 if you're married of capital gains from the sale of a home. Our conclusion from looking at the data, looking at other studies, is that these preferences do very little to increase the level of home ownership. They provide no subsidy to the nearly 2/3 of taxpayers who don't itemize on their tax return, and only a modest subsidy to itemizers in the 15% bracket, although I suspect very few people in this room are in the 15% bracket. In fact, most Americans are in either the 0 or 15% bracket. The value is the largest for upper middle income families. These are the ones who would be the most likely to own a home without the subsidy. But the subsidy doesn't have no effect. It reduces the cost of housing for these families, and so it encourages them to buy larger and more expensive homes with borrowed money. And in some areas where land is scarce, it drives up the price of housing and perhaps crowds other people out of the housing market. So it does have effects, but not ones that we necessarily would want to use the public money for. Other countries, Canada, Australia, the United Kingdom, have reduced, eliminated, or phased out their deductions. And in those countries, without a mortgage deduction, the home ownership rate is as high as it is in the United States. So what can we do about it? Well, if we do want to encourage home ownership nonetheless through the tax code, we could restructure the deduction in a variety of ways. We could have a uniform percentage credit, either refundable or not, that would broaden the number of people eligible for a subsidy, and it would reduce the subsidy at the highest end, and so it would promote more home ownership and could be designed to cost less money. We could also have an investment credit for first home purchases. Even if we don't go that far, we can do certain ways of eliminating the deduction, reducing the cap. It's now you can get the deduction on up to $1 million of borrowed money. There are a lot of proposals out there to reduce that to $500,000, $250,000 maybe. We could eliminate the deduction for second homes. As a new buyer of a vacation home, I don't like that proposal, but it's very hard to justify that subsidy, and we could also eliminate the deduction for home equity loans. So there's a lot of things we could, other ways we could do that. A number of federal panels have endorsed proposals like this. The federal tax reform panel introduced by George Bush in 2005, appointed by Bush rather. The National Commission on Fiscal and Responsibility and Reform, that's Bowles-Simpson, that President Obama appointed in 2010, and the Bipartisan Policy Center's Debt Reduction Task Force, all suggested replacing the deduction with some form of an interest credit. Finally, say obviously people are concerned with pulling out the rug from the housing market by introducing the deduction and what the effect would be on prices. So the qualification to this is we should do this gradually and phase it in, not to disrupt the market too much. Although the price effects may be less than some have claimed, and there is some research by my former colleague Ben Harris at the Urban Institute and others who have said it might be overstated, and we have a working paper out on that the Housing Policy Center put out, Metro put out last year. Finally, I guess you just asked the question, if we were designing the tax system today, would we allow the deductibility of mortgage interest? And my guess is the answer is no.
So before I turn to Laurie, Ralph, I want to go back to you for just a second. If we did do away with the mortgage interest deduction, have you done any thinking about what it would do to make, in particular, the baby boomer piece and the state differential piece of your puzzle easier or harder to solve?
That's a good question, Ellen.
Okay, I'll let you think about it while I go to Laurie. So, Laurie, Ralph and Signamary have convinced us that everyone is below average, and yet all the work that you've been doing has really talked a lot about the very tight credit box that we have here today. What's out there that might actually make a difference on that subject?
Yeah, I mean, I think there are three things. So first, the average credit score for the universe of purchase borrowers has increased from 710 in 2001 to 715 between 2004 and 2007 to over 740 in the last few years. And actually, you can find these numbers in our monthly chart book. The LTV hasn't changed very much over time, but since 2009, FHA has become an increasingly important source of purchase money for lower down payment mortgages because all other outlets have disappeared. And I think there are basically three factors contributing to this tight credit box. The first, actually two of them involve some sort of form of government policy, or arguably all three of them do. First, rep and warrant risk. Second, regulatory uncertainty. And third, the fact that we've been in a low rate refi market, which has produced capacity constraints on the part of the originators, and that's changing. So let's actually look at the rep and warrant risk. The lender's concern is that if a loan defaults for any reason, the GSEs will assert the default is due to improper underwriting and put back or force the lenders to repurchase the loan instead of paying the credit guarantee. So a consequence of this is that lenders have become overly cautious, raising minimum credit standards to make a loan well above what the GSEs would require. And a second consequence of this is both the lenders and the GSEs believe that they need to be compensated for the default risk, so the borrower is in essence paying twice. Now actually, Freddie and Fannie both released credit databases in support of their risk sharing initiative, and one unanticipated sort of nice fact about these databases, especially the Freddie database, is it actually lets us look at the putback issue. And what we found is while this database only covers full doc amortizing 30-year loans, it's similar to the type of loans that are being made now, and allows you to look explicitly about how these loans would have performed, would have been put back over time. We find that the putbacks are actually quite small relative to their impact on lender behavior and credit availability. Excluding loans purchased by the GSEs in the 2006 to 2008 period, when both lender and GSE underwriting standards were very, very low, Putbacks since 2000 have been really tiny relative to the number of mortgages originated. However, the 2006 to 2008 experience has clearly tainted the lender's view of the frequency of putbacks and encouraged them to apply these credit overlays. So our analysis indicates that the GSEs would suffer negligible minimal negative consequences if they implemented a sunset period of 2 years rather than 3 years and allowed for loans that had a less than perfect pay history. And the losses would be even smaller with the enhanced upfront due diligence the GSEs are currently doing. These policies would produce greater certainty for lenders, reduce the duplication of charges for bearing credit risk, and encourage the expansion of credit. The second issue is regulatory uncertainty. Banks have been very reluctant to expand the credit box due to regulatory uncertainty. Some of that uncertainty has been removed with QM resolved and a proposal for QRM that's more benign than what many had expected. However, disparate impact remains an issue as it's more difficult for lenders to consider compensating factors. If uniform application of credit standards produces a differential impact on individuals of different races, national origins, or sexes, the lender could be liable for disparate impact liability. The legitimate defense and the burden of proof rests with the lender and must be supported by the evidence, and that and they have to show that it was a justifiable business decision. So what this does is require clear adherence to guidelines with less room for judgment on the lender's part. And I think that uncertainty is sort of increasing the is increasing the ability to cope with compensating factors. And finally, lower rates have contributed to the narrow credit box. Lenders were so busy getting refinanced loans through the system that they had no motivation to try to accommodate that marginal purchase borrower. With fewer constraints due to higher rates, we'd expect to see a small but perceptible widening of credit in the months ahead, but it's going to be very small until we solve the rep and warrant issue and the regulatory uncertainty issue. So we need a consistent set of rules that enable broader credit availability while shielding lenders from the putback litigation risk associated with making the business decision to lend to less than pristine borrowers who have the ability to pay. There's no question that standards were way too loose in the 2006 to 2008 period, but we've now closed the door. We've now closed the barn door long after the horse has left, leaving us in an environment with constrained credit. And these issues become even larger when one considers the changing demographics that Rolf and Signa Mary talked about.
So Jim, you've written also about reps and warrants and its impact on the credit box. But you've been in the political world. How realistic is it that the improvements that Laurie talks about will come to pass?
I'm actually kind of optimistic about the reps and warrants topic. When I think of the challenge on access to credit, I sort of think of them as twofold. One is the challenge of current overlays driven by the very things that Laurie's talked about, including reps and warrants. I'm mildly optimistic about that set of challenges. FHFA has been working on this for some time. FHA has been working on this for some time, and it's largely a matter of sitting down with lenders and clarifying the sources of uncertainty that are causing lenders to protect themselves against uncertainty by the overlays. There's sort of increasing public concern and pressure on the regulators to provide greater clarity. I think everyone understands that it's a source of one of the sources that's driving the credit overlay. So it feels like everybody's got the right intentions in this. It's a matter of how high a priority it is and how sort of expeditiously they move. But it feels like it's gotten to be a higher priority lately, and that so I'm mildly optimistic on sort of that set of problems. A set of problems that's related to that I'm a little less optimistic about. Around credit or around access to credit is policymakers looking forward, thinking about new rules, new reforms, structural changes to the market, try to strike the balance between minimizing risk in the system and maintaining broad access. I fear a bit that our recent history of focusing almost exclusively on minimizing risk in the system at the expense of access to credit will continue. I think understandably policymakers' instincts right now all gravitate towards minimizing risk in the system, which shouldn't be a surprise given what we've come through, and it's probably healthy. But if you think about all the things that we all focus on in this sector right now, increasing skin in the game through risk retention, minimizing risk to the taxpayer through bringing down loan limits, say, putting more capital ahead of the taxpayer's risk, greater enforcement on bad actors in the system, all the things that policymakers have been focused on the last several years have been sort of uniformly pushing in the direction of lowering risk in the system, and all healthy to do and focus on. But one of the consequences of that is it's also, in the aggregate especially, really constraining access to credit structurally, not just through this. I think of the reps and warrants driver of contracting credit as a sort of inefficiency in policy making. It's sort of sloppiness in writing the rules, which we can correct by clarity. But these other factors are really conscious choices, structural choices about what the contours of the market should look like, that are going to be a lot harder to fix and address going forward. And it feels like, because policymakers have this understandable inclination to want to minimize risk right now, that will continue as we think about new places to land with reforms and think about things that are structural like GSE reform, will continue sort of overcorrecting from the mistakes that we've come through in the past. And to me, the $64,000 question is what the eventual political reaction is to this as these steps aggregate and their impact in constraining credit gets bigger in the aggregate, and how far, in a sense, the pendulum has to swing before there is a considerable pushback. And you sort of think anecdotally, to drive the point home, what happens when the congressman in California wakes up with calls from his constituents who just yesterday used to be able to get 30-year fixed rate loans with 5 or 10% down and find themselves waking up in a neighborhood that no longer has government support in the way that it did before because of loan limits coming down, who now have to put down, say, 25%. Or when the same congressman goes to an African-American community to have a town hall and finds, by show of hands, that 2 out of every 3 folks in the town hall have been turned down for a loan. Like, these are the realities that we're moving towards with these steps. And so the question is, I assume, what the political reaction to all this is going to be. And my assumption is, as we cross these sorts of thresholds over time, you're going to wind up with a lot of political actors in the system who currently aren't paying attention to this, who are going to jump in this discussion with both feet, and it will change the dynamics of these discussions a great deal. A lot of the folks in this room move from this room to rooms like it all over town and talk about.
Some did this morning.
That's right, exactly. And then we'll move back. And so we do this here, we do it in New York, and we fly around. We ought to have a big plane that takes us all around to do this all over the place. But we had these same discussions, and we all talk in the same terms of this ideal, almost abstract ideal of a housing finance system that has minimal risk and maximal efficiency and all of that, all of which is good, and it's a good way to start the conversation. But there are a lot of folks that aren't part of this conversation that likely will become part of the conversation when their constituents find that the housing finance world has shifted beneath their feet without them realizing it. And my guess is that will pull the pendulum back towards probably a healthier balance in weighing access to credit against managing risk to the system. But when that happens and how far the pendulum's got to swing for us to have that sort of moment of reconciliation is pretty uncertain.
So maybe, Signa Mary, you can help us a little with some data. You got some information there about what the gaps really look like and how big they're heading towards, and the size, and who's going to be in that homeowner population going forward?
Yeah, I think homeownership has been the key avenue that Americans use to build wealth. And what it is, it's not just that housing prices appreciate, it's that automatic savings vehicle that every month your mortgage payment comes due. So I see Bob Lehrman's here, and he has a brief that we have out there with Gene Sterling and CC Jan. And it talks about that there's been such an intense focus on the losses of one specific group of homeowners, these ones during the Great Recession. And you don't want to be in a position where homeownership is promoted when prices are high, like they were before the Great Recession, and then not promoted now that prices are lower and interest rates are lower in some areas after the Great Recession. So you don't want a prescription that's made independently of market conditions. We don't want to be telling people, especially lower income people, to buy high, but don't buy low now that things are low. So with the financial crisis, credit documentation and down payment or mortgages have tightened since it. And there was a need to address this lack of underwriting and documentation. But this swift policy shift in the opposite direction with talks of 10, 20, even 30% down payment requirements, this is going to create impossible barriers to homeownership for some populations. If you look again at your populations by race, white families are 5 times more likely to get a large gift or inheritance than African American and Latino families. So think about what that large gift or inheritance is used for, right? It's going to be for the down payment on a home. It's going to be for college tuition, those stepping stones to the middle class. So, this kind of stricter access to credit is going to exacerbate the increasing wealth inequality that we're already seeing.
If I could add something to that, the HMDA data that came out recently for last year has in it an amazing statistic, which is in 2012, and you guys correct me if I have this wrong, in 2012, 52% of African Americans who applied for a conforming non-jumbo loan were turned down, as opposed to I think 12 or 13% for white Americans. And so you wind up, again, as we move in a direction in which there are more and more rules that point in this sort of direction of a contraction, it's going to affect certain demographic groups dramatically more than other demographic groups. And you've got some laws in the books that are meant to push the other way, like the disparate impact laws, which put lenders in a real bind where if they're going to comply with the rules that we're putting in place to constrain credit, then it's going to lead to extremely disparate impacts across various markets that will get only more disparate as more rules like this take hold. And the disparate impact stuff is really just while legally it's extremely important, it's really a symbol for the broader problem, which is if you keep pushing in this direction, you're going to have an actual disparate impact across many communities that will have a trickle-down effect through those communities in a way that is both damaging and is difficult to sort of unwind over time. So
right, so it's not just what people are wondering. We have that brief out there right now from the Opportunity and Ownership Program that looks at the HMDA data, and it says exactly what you're saying, that denial rates are increasing. We're seeing that tightening of credit.
So I could ask Eric how he would spend the mortgage interest deduction money if we were able to repeal it to try to equalize some of this, but I think he's probably not prepared for that one. And having, so Laurie, if thinking about the housing finance system, what are the kinds of things that could be done reasonably quickly to not get us all the way to the point where none of the people Sigmund Mary has been talking about can become homeowners? And Rolf, I will get back to you about what happens with the mortgage interest deduction. And people on the web, please, we've gotten one question, actually a rather nice question in, but we would like some more. Go ahead.
I think the three things I think the resolving the regulatory uncertainty and clarification on reps and warrants would be huge steps. But no matter what you do, I think we are in an inevitable path where the home ownership rate is going to decline over time. And I think both Rolf and Seidman Mary did a great job sort of talking about how the minority share of new household formation continues to grow, and blacks and Hispanics have much lower wealth and lower home ownership rate than whites. Student loan debt is an increasing burden on many young households. Real incomes, and Seidman Mary made this point earlier, real incomes have been flat nationwide since 1995, but they've actually been declining over the age group that buys homes. And there's also been a subtle change in attitudes towards home ownership. While my generation saw home ownership as a store of value, my kids see it as a lawn to mow and a vacation to be foregone to save for the down payment. And things that smack of the labor-leisure trade-off is a bad thing, and you don't see home ownership as that incredible store of value that my generation did. So I think, no matter what, you've got an inevitable push toward lower home ownership rates. Now, obviously, household formation remains the same. Home ownership rates decline. It means that you end up with a lot more rental units. You have to focus much more on multifamily, much more on sort of single-family rental, and I think that's going to be the challenge for us going forward.
So, Rolf?
So I'd say one of the great things about having Housing Finance join the Urban Institute and really be embedded in the Metropolitan Housing and Communities Policy Center is that we've actually been looking at many of these issues for quite a long time. The stars at Metro, including Kathy Pettit and Leah Hendy, who are in the audience, and Peter Tatian have been looking at a lot of these issues at the neighborhood and the metropolitan level for a really long time. So, obviously California and New York and Washington, D.C. have really high house prices, and they have a lot of high-income individuals. Those are the places where the benefit of the mortgage interest deduction, tends to concentrate. More than, for example, it would in Texas or in Michigan these days. So, thinking about the geographic specificity of all of these policy questions, I think it's really critical. Seidman talks about who and how these policies play out across different groups in society. We're also thinking about where, and when it comes to phone calls from your congressman in California, he or she is really thinking about what his or her constituents are seeing and feeling right now. And so really, I don't know the answer to the question, how will the politics evolve as the impacts of our policy framework play out in markets for families and for constituents? I have no idea what the answer to that is going to be, but having a center here actually allows us to get traction on questions like that, not just what should the policy be, but also how will the politics evolve, and how can well-informed policy analysis help, as our colleague Lionel Foster puts it, dial back the crazy in a lot of the conversation that happens. That's really, I think, what we're trying to do is reduce the level of animosity and elevate the debate on housing policy generally, on housing finance policy in specific, but more broadly, I think, on urban policy in the United States as we prepare for some pretty important demographic and economic transitions.
That is a great statement. And Eric?
Yeah, I just want to make a brief statement in response to your question.
Go ahead.
And I was glad gave you a pass, but not because I haven't figured out a way to spend the money or there aren't suggestions. It's that there are too many suggestions. And just to sort of put it, I mean, there are some people in the context of this, I was really talking about home ownership and weighing ways of using it to make home ownership subsidies more effective. There are going to be other people who think some of that money should be spent on rental housing.
Exactly.
There are yet other people who think that money should be used to reduce tax rates. That's the tax reform crowd. There's the budget deficit crowd that thinks we should be doing something about the budget deficit. So I think it's, a real question that's raised is, does this money that we spend on the mortgage interest deduction somehow belong to the housing sector, or is it available for something else? I won't answer that.
One quick thing I would add is one of the silver linings about GSE reform moving so slowly, and there are not that many, but one of them, is hopefully by the time we get to a place where we pull the trigger on real legislation, that's not just another proposal, another mousetrap from another center or another bill, but an actual negotiation over real legislation. Hopefully by that time we will have seen the impact of a lot of these regulatory moves. And we will have, in a sense, digested politically what the implications of tighter access to credit really mean, so that by the time we actually move on overhauling the world as we know it through GSE reform, we're a little bit better informed about what the trade-offs really look and feel like. If we had actually made decisions about GSE reform, say last year, before any of the impacts of these regulations had taken effect, my guess is it would have been radically conservative as far as constraining credit. And my guess is the longer that timeline is pushed out, the less likely the reform is to land there, in part because we're beginning to sort of internalize what it means to actually minimize risk in the system through a lot of the regulations that are sort of going out now.
An optimistic
That's my nature.
thing to land on here. Okay, I have one question from the web, and if you are on the web and want to send a question, it's events@urban.org. And we're going to have some mics in the room. People can raise. Joe Ventrone, you're going to go first, but hold on a second. I'm going to ask the web question first. Zach Fox of SNL Financial asks a question which basically boils down to, and Laurie, this is for you, how much risk is there in the GSE book of business, and should we be worried about it? And if there isn't very much risk in the current GSE book of business, why has the PLS market not started up?
Very good question. So the new GSE book of business is, that is the loans undertaken since 2009 are absolutely pristine. You have very low LTVs, very, very high FICO scores. The average FICO score of that book of business is over 760. And the G fees have risen very, very rapidly from around 26 basis points in 2008 to around 56 basis points now. So that is an extremely profitable book of business. So you look at that and you say, well, gee, if you've got a 70 LTV, 760 FICO loan, that type of loan is apt to incur, say, 5 basis points a year of losses, or 25 basis points lifetime losses. Why are people willing to pay 50 basis point G fee for that? Why aren't those loans going the private label securitization route or the bank portfolio route? And the answer is some of those loans are going the bank portfolio route. And matter of fact, what the banks are doing, and which is natural, is you basically take some of the highest quality loans for your portfolio. Makes perfect sense with the pricing schemes. The PLSs have been very, very slow to take off. I think there are a lot of reasons for it. One of them is that in order to create a sustainable PLS market, you really need standardization. People can't be having to read page 177 of the prospectus to figure out that there's some wrinkle. You need standardized information at origination, which is actually being provided. You need a more or less standard structure. You need standard reporting on dealing with servicer behavior, which has not been done. You need standardized procedures for dealing with reps and warrants, which we're inching toward, but also has not been done. My view is until you get standardization, you can't get a PLS market in any size, and the PLS market has been particularly tough the last couple of months. I mean, there's just been a number of deals pulled, but I have confidence that it will come back, but I do think you need the standardization first.
Okay, great. Joe?
The National Association of Realtors. I also commend Sarah Wartell and the Urban Institute on this new initiative. I believe we need a new forum to discuss housing finance. My first question is really a comment to Eric Toto. I appreciate your comments on the mortgage interest deduction, obviously, and just direct people. Dr. John Weicker from the Hudson Institute did a paper recently showing the benefit of the deduction to the middle class, so I just share that as information. My next question is to Jim Parrott, and I'm glad that Jim Parrott is part of this group. Eminent domain is a very interesting topic, and I commend the paper that was forthcoming. As we all know, the FHFA opined on the eminent domain. I'm going to rush, Alan, believe me. Opined on the eminent domain and issued a a solicitation, but I'm wondering why Ginnie Mae, that this would impact Ginnie Mae Securities, hasn't opined anything from the HUD standpoint. Thank you.
That's a tough question. So,
Doesn't work there anymore.
what's that?
Doesn't work there anymore.
Yeah, right. So, I mean, to be perfectly frank, the politics of eminent domain are just brutal. My sense is, even if you were of the view that it's bad policy, that at the end of the day, and folks should really read the paper that Pam put out, because it's a really useful commentary on why the objectives sought by those trying to lever eminent domain as a tool don't succeed in meeting the objectives and have a lot of collateral consequences to liquidity in communities like that. So there are reasons to be very skeptical about the utility of that lever, as it were. But even if one believed that as a policymaker within, say, the administration, the politics are really difficult. And the reason why they're difficult is if you're a community that has been struggling from acute distress all the way through the market, you've used the resources that the administration's tried to avail to you, but you've still got acute distress. So you then take it upon yourself to come up with a local solution to this problem that the federal solutions have been adequate to address. And so this is the solution you come out with, even if it's a bad solution, as it would be understandable to think. And the very federal government who you think has been inadequately responsive to your needs comes out and pulls the rug out from under your effort to help yourself. I mean, that's just that's a narrative that's a very difficult narrative you got to be really confident in walking into. And that's frankly the narrative that Secretary Donovan and folks, if they pulled that trigger, would walk into. So I think if you believe that policy conclusion, then you hope that you can find better local solutions. You hope the court sorts it out so that you don't have to jump in that mess, and you frankly wait and jump in the mess only when it becomes clear that you're the only one who can actually pull the plug on it. So to me, the politics are what makes it hard for them to jump in, I think.
Okay. So Alice, you have Elise, sorry.
National Consumer Law Center. So I have a question and then sort of some context for the question. The question is, how can we use research going forward to not make the same mistakes we made before, that when we wanted to open access and creativity in the market before, we ended up gutting the same communities we were trying to help? And 4 little points on that. One is, so we had problems with access in certain communities, and Community Reinvestment Act was passed. But because of a lot of redlining, we ended up having predatory lending in those communities. We also decided to really pull back on certain broker compensation structures and access issues, and we also said, okay, now we're going to address affordability. And in all of that, we've got some loopholes. So in addition to the overcorrection that Jim's talking about, we've still got an undercorrection. And so as we go forward, what kind of research can we do to make sure that the overcorrection is also looking at where we've had undercorrection, including on foreclosure where there's been almost no correction?
Okay, can we just take that one question?
That's
huge.
all one question, that's
Okay,
it.
good.
The subparts are, brokers and access.
Okay. Laurie, you want to start?
So there are a couple of things. First, a huge percentage of the loans made in the 2005 to 2007 period were low or minimal documentation loans, and you would hope that that's something that would never come back. I think you need the information. Second, I think we've learned a lot from that experience as to how bad it can get. We've learned the impact of risk layering. We've now got a lot more data. Sort of going into the 2005, 2006 period, no one could have envisioned the types of losses that occurred, because we couldn't have envisioned the type of home price depreciation that occurred, and how as you began to see a little bit of a foreclosure problem, home prices declined, you got more homes on the market, home prices declined more, and I think no one envisioned that sort of feedback loop to the extent it occurred. So we've learned an awful lot about risk layering and sort of the systemic risk in the system, and I think that's a set of mistakes that won't occur today. Having said that, I think you got to be careful about not going from, oh, we only want to make loans that never default because that so constrains credit availability, to something that's a little bit more balanced. And certainly, paying attention to documentation, paying attention to risk layering, and I think the better data we've acquired will prevent this problem from happening again.
I think just to exercise my prerogative, that one of the other things research can do is take a look at, do some work on some of the compensating factors, do some work on issues like to what extent does counseling actually work, and what does it mean, and what kind of counseling can work, to what extent, to build on some of the work Sigmund Mary has done, would developing kinds of savings vehicles that play into a down payment and help you keep saving even outside of the mortgage, even once you've got a home. I mean, I think we can, and I think here at Urban we've got the capacity, and I think this is going to end up being the end here. I think we've got the capacity to think broadly about a lot of these things and how you might mitigate, what the impacts are on communities, how community A will behave differently than community B under exactly the same financial system, and to let the policymakers know real time what some of those possible answers are, what some of the possible responses are, and how some of the responses that are being considered may or may not play out, both in general and in individual communities and households.
Yeah, and just to chime in on that, Elise, some joint research that we did with CFED showed that people who bought their home through an individual development account program had 1/3 to 1/2 the foreclosures of other families, similar families in the same communities. So some of these savings vehicles that wrap in down payment assistance and counseling can help offset some of that.
So I'm going to take one more question, because this gentleman has really been trying very hard, and I thought I was closing it out, but Sigmund Mary, this is the price you get. We're going to have one more question.
Alejandro Ezebra with the National Association of Hispanic Real Estate Professionals. It was Laurie who more explicitly made reference to the growing importance of Hispanic and Asians to household formation, housing demand. Everything is not depressing in terms of market potential. Here in the Washington, D.C. metropolitan area, 20 to 25% of Hispanic households have incomes over $100,000. And Fannie Mae just released its National Housing Survey entitled Hispanics Driving Homeownership Demand. So I'd like to see if you can discuss more the importance of Hispanics and Asians to the housing sector.
So what I think we're going to do is have a new piece of research, because we really do have to end. Our webcast time is just about over, but the point is very well taken, that you can't paint any group with a very broad brush and assume that you've got everybody. There's diversity within groups as well as between. So that's a very important reminder, and thank you. Sarah?
So let me just end by saying one more moment about our aspirations. So the folks on the panel and others here have represented a large body of work that has insights that are relevant to policy discussions that many of the people in this room, myself included, are part of every day. And the challenge for us is going to be to take those rigorous and sometimes a little bit dense and wonky papers and find the insights from it. So you start from the analytic work, you find the ways to turn that into an issue brief, into an infographic, into a quick hit, maybe even to something that some of us can tweet. But the difference will be that we know that if you want to go to the other layers back down and dig on behind, at the base of that stands the research that my colleagues here are capable of doing. And I hope that you can help us by helping us understand how to draw, what the questions are that we need answering, what the conversations are that are not well enough informed, and where we can bring that research to bear. It's one reason we're so excited to have Jim as part of this team, and I probably didn't do credit to what a thrill it is for us, because on all sides of the aisle and in industry and in consumer groups, people are so pleased because he's such a great synthesizer of these conversations, and it really kind of brings us back out of the numbers into the conversation and why this all matters. I also love being in an academic institution. We have a lot of diverse disciplines here, but we also have a lot of diverse perspectives here. And from the Urban Institute, we're home to people who look at the same numbers and may form different conclusions from it. And that's part of what's exciting here. And we want to make sure that we are inviting others who look at the same numbers around the table with us and may draw different conclusions, but we want to have that conversation. So I hope for all of you, this is the beginning of your engaging with us around that set of principles. Help us be better, help us be more helpful to the conversations that you're all in. Thank you for coming, and thank you for being part of this journey with us. And I forgot to give one last plug. Look for the symposium on November 20th with Corlotic, the role of data in these conversations. Thank you.